Okay, hi, Yunus. Thank you very much for joining me for this book reading. How are you today?
Thanks a lot for inviting me. And you?
Yeah, I'm well. Thank you very much. So today we are going to be looking at chapter two of the book, which is Venture Capital in Bird's Eye View, right? Just to give you that overall understanding of venture capital, some of its intricacies, right? So a lot of times we hear about power law, we hear about limited partners, general partners, fund life cycle, and all of these things could sound like rocket science at the outset, right? So we are just going to be breaking that down in very simple and clear English. As is our standard, we'll start by learning about the guest. So, Eunice, the floor is yours. Please tell us about yourself and your background.
Hi everyone. My name is Yunus Ibrahim, and I currently work as a venture builder at 54 Collective. Before this, I previously worked as an analyst at Future Africa, which is also another early stage VC firm on the continent. Further in my background has been in investment management, where I support high net worth individuals in finding and investing in alternative opportunities.
Right, interesting. So, guys, you can already tell for yourself that he's very, very vast in the space, right? So, without wasting much time, I'll just go straight into it. I'm just going to read a part of the book that gives an overall. So, this chapter presents some of the unique characteristics of VC, distinguishing it from other sources of funding to startups. It also aims to introduce you to some of the key concepts you will encounter as you journey through this book. So now let's start off with some of those key concepts, right? So Yunus, from your experience, what are those unique characteristics of venture capital, right? That tends to makes it stand out from every other sources of funding to businesses out there. So just tell us a bit more about the characteristics of venture capital firms.
Um, Thanks a lot, Miracle. I think for me, with my learnings over the years, one standout statistic of venture capital is really like the transformative role venture capital actually plays in an ecosystem or in an economic they you know if you look at the various aspects of companies, right? So one might be public and private, but then why public companies, which are usually like the large ones like Dangote Cement and all that listed, do have like opportunities to raise money from banks, even from the stock exchange. But a lot of private companies are typically smaller, right? So what that means is
Mhm.
that they don't get the capital they need to actually capitalize. So VC then serve as the appropriate vehicle to help, that founder on the streets that has nobody, that has no network, but has the disruptive idea that could be very transformative, provide capital to them, and not just capital, also support um such founder or an entrepreneur in the journey. But right, also if you look at the various players in this value chain, the VC is not like directly providing that support to just the founder alone, but also enabling other people in the ecosystem. Um, so I remember like while reading the book, Tapping Point actually stood up for me. One around how VC even help like, other investors, which are like the limited partners to find these startups, even help like investment bankers when the startup want to sell, creating value for them from a downstream point of view. And that's just like very, very helpful. So in essence, I would say the key role that VC play is really like the transformative impact in the ecosystem, not just to founders, but to also other stakeholders within an economy.
Yeah, makes a lot of sense, right? And we use the word like a linchpin, right, to describe it. So an integral part in a bigger system, right, making that sort of connection. So one thing we tend to see a lot is the fact that it almost seems as if this is a more tilted to technology-based businesses, right? And we hear a lot about growth potential, ability to achieve fast growth within a short time frame. So, what are your thoughts around the sort of startups that VCs tend to invest into from that point of view of high growth potential?
I think I would really want to start with the layer of the land around like what exactly do we mean by high growth potential, or on what exactly is this the are VCs interested in like the term high growth potential. So the way a VC fund is structured is like from the point you invest up to the point you take out your capital, right? Their definitive timeline, which is usually less or exactly 10 years, right? So what that means is that um this will actually begin to inform the sort of businesses that you look out for, which means that those businesses, must have the ability to scale and move quickly, right? Thinking about like ability to reach more people, ability to like generate revenue, right? And then this is where the lens of technology actually comes in. We all understand that technology is essentially an enabler to do things better and more efficiently, right? Let's say a small business on the street, right? A small business on the street would open every day, waiting for working customers versus a startup founder actually that has built not just a website or is leveraging AI to optimize processes, which means that you're not restricted to just sell within your geography or your region,
Mm.
right? I might actually be in the corner of my area in Yaba and be able to sell to like global customers. So that's how like this they thinks about technology and technology being an enabler to really help them. I think another aspect around why we're very, very interested in technology as well, or tech enabled or tech driven startup, it's also like the ability to be disruptive and like create and open your market. In reference to the book, there was something that really stood out for me around like this M-Pesa. So I think this is not just limited to Kenya, around like, how banks actually are more concentrated in urban cities, and now it didn't make commercial sense for banks actually to go open areas in rural areas. So I would encourage more people to read the book and really understand the story around it. But even if you bring this to Nigeria, we saw how the advent of like InterSwitch and InterSwitch and Flutterwave actually enabled people to pay online. Previously, it was difficult to make payments online. You have to work in, and how despite that we had like a goal case system even as of then. But what then happens is that the ability for startup founders to think about using technology to make things better actually and a new industry and created a new industry, which is like the digital payment system, which we are still reaping from today. So like when you really think about technology, I think beyond tech fitting into VC model in general, it's also talked about like the impact and the ability for the startups to quickly grow, and exit and be able to help VCs return money back to the investor.
You touched on something, that aspect of disruption. But again, you find out that disruption is one word that is frequently used, but then it seems as if the concept around it is somehow misunderstood. That sometimes people have to always think of, oh, you have to bring in something entirely new, right? Maybe you invent one thing that the buzzword from zero to one, right? But many times, sometimes about thinking about setting traditional industries, right, that has kind of reached let's say that point of maturity. For instance, if you look at the automobile, for instance, reach that sort of maturity whereby growth rate is usually very small, 2%, 3%, and may not be very, very attractive to see that high growth potential. But because of the fact that technology tends to unlock new growth potentials in existing industries, so it's now more or less thinking about how you can now leverage that technology to create new business models that tend to change the game in those mature industries, like we saw for M-Pesa, right, with what they did in terms of banking, mobile banking in Kenya. So it makes a lot of sense, right? So I think the other part that is also very critical when it comes to the characteristics of VCs, which you just mentioned, is the fact that they have like a fixed time horizon, right? It's not one that they are looking at, oh, staying with you for 100 years and maybe you transferring the business to your children and children. No, it's not that. So they have a fixed time horizon, right? That they want to exit. Sometimes you see them exiting 5 years, sometimes you see them exiting 7 years. And so I think that creates a smooth transition into my next question. Right. So we see this concept around in terms of how a VC is structured, that we have like limited partnership and general, and we have the limited partners and the general partners. So can you help us to understand one, how a VC is structured, and then secondly, what the fund life cycle looks like in a VC? I think that will help us understand why it seems as if VCs are in a haste. Where are they running to?
Sure. Um, Thank you. I think that's a very good question and it's to clarify. So when we talk about partnership in general, right? So partnership essentially means like two different individuals or two different entities coming together to say, look, we want to do something together. We want to collaborate, right? And that is the tenant in which like the venture capital industry is built on. So with that in mind, the venture capital industry is a partnership between two different individuals or two different legal individuals to put it that way. So one is the limited partner and the other is the general partner, right? So and this is what makes venture capital unique. So VC, in essence, right, I can say we do not invest in our money. We do not invest our money. We actually collect money from other individuals that are looking to invest or other entities. So those are the limited partners, right? So I think, so in essence, limited partner are the provider of the capital. All they do is, this is my capital, this is my money, I want to invest. Yes, like the HNIs, right? Or maybe even family offices, right? Like we've seen like different family offices globally. I think there are also some in Nigeria, the Osage and the likes. So they will use that and then I'll give it to an LP, to a GP. Then the GP now is the venture capital firm or the individual representing the venture capital firm that essentially have to manage this fund on behalf of the limited partner that's provided the capital. And the core responsibility of the general partner is really around like overseeing the operations of that money, which we also call the fund that have been provided by the LP. So say the general partner thinks about make decision as to what startups to invest in, they ensure and oversee the investment process. Also think about like, who do I need to bring on board to support me? What talents do I need, to actually get this done? Also think about like the operations of the fund in general, like how do I decide what sectors and all of this technicalities, right? So, and in essence, the general partner then get something in return for like managing that fund, which is called like the management fee. I think the book also talked about like the standard for management fee being 1.5% to 2.5% on the total amount raised. Let's say, for example, if the limited partner provided like $100 million. So what that means is that the GP cannot charge beyond 2.5% in management fee. So all of the incidental costs is just capped at 2.5%, right? Then apart from that as well, there's also some sort of arrangement where if the general partner, which is the venture capital firm here, is able to deliver return and say, oh, I am able to invest and I generate more than the $100 million. Let's say the limited partner provides $100 million, and at the end of the day, after your investment and you get your return, you get like $200 million. So the $100 million difference, right? The GP can charge up to 20% in carry. But the amount as to whether you charge or not, of course, will be agreed in some sort of contractual agreement between both. So to your second question around the fund life cycle, right? So remember I had mentioned that there are certain individuals that provided this capital who are the LPs. They also have an objective and investment horizon in mind, like how long they want to keep their money for, right? And then typically, right, that is within 10 years period. So what that means is that the general partner, which is venture capital firm, have within 10 years to decide what to invest in, support the founders, get exit and return the money back, right? So it's really just cast in stone that way. And if you then take a step back into the various activities or phases within the fund life cycle, which I actually found very interesting the way it was structured in the book, as to the first within that 10 years, you also fundraising. So after you fundraise, you got some money from different LPs. The next thing is also now thinking about spending the next 3 to 5 years deciding what startup to invest in, what not to invest in, and all of that. Like after you've made investment decision, you would also be able to like provide support, right? Which is where BC creates a lot of value beyond just throwing their money and going back. No, you actually work where your mouth. You put your money back. You work, provide portfolio support around, is it good strategies?
Could be your good at was a venture builder.
Yeah, the core of my work as a venture builder, really thinking about how can we de-risk this investment? What do we need to do next, right? To ensure that this startup succeed. each VC has their own like expertise or network or what they prioritize as the tenets of building a successful startup, and you provide that support. And then the next stage is like exiting, right? So all of this work happens within that 10 years as well. And I think there was really this graphical illustration or concept in the book, which I found interesting as well. Because the J curve, right? So I'm gonna break this down in a very simple term, right? You know the normal way we did graphs in school, quadratic equation, you're now representing it graphically. So if you look at that line, which is the origin, that's actually the performance, right? So back to what I've said, right? When you think about like the fund performance or the fund life cycle in general, like in the early years, I said that within the first 5 years, all they are doing is spending money, hiring, bringing people on board to rally around the vision of helping. Are you also sending out money? So that means that all of that falls below the zero, which is if the zero is like the performance origin, right? Like that negative. The VC is not making money. So it means that the LP has given you a strong 10 years. So you must be making a good call while you are investing in these things, right? And then eventually, right, as you continue to like realize your investment, maybe someone bought startup A that you've invested in like 2 years ago and now it's year seven, or startup C is in their 8 years. They've gone to this on Nigeria Stock Exchange, amen, in the future. And then, you know, you start getting your money back. So you
And let's not forget that some start with the we have to write them off.
in fact, part of blowing up and you like them up is what the victim goal and the LP is also aware that not all of this will like the coins, which is where like the sort of thing that you bring on board comes in around like getting the first deal. The first it's like how do you get the first deal? How do you support? How do you actually like a whole lot of things around like investment decision in general, right? So it's actually interesting because within that 10 years we've seen funds that unfortunately haven't been able to prove that and have not been able to return money. The implication of that is like the funds that is coming into the ecosystem, especially in Africa, where we're still young, will be reduced because no one wants to give money to someone that cannot prove it. Like we were talking about, individual LPs are using their pension, money they are trying to use to like create financial security for their generation as well. Corporates coming in are actually using their balance sheet and trying to see how they can use this as some sort of treasury management. It's just very sexy. So if you don't return that money, there is like a likelihood that that might be the end of the fund, or you start thinking around pitching another story, or pivoting, just like startup pivot as well. It's a whole lot of drama happening. Hopefully you get to speak about.
Yeah. No, interesting. And you really touched on very, very, very salient points, right? So, I think one particular context that we could have maybe we didn't zoom into more at the point of talking about the characteristics of VCs. That part of talking about high risk, high rewards, right? And that's very, very crucial because VC, the asset class VC is not like every other asset class. Maybe investing into public equities and all of that, or investing into bonds, right? So there is 100% chance that you can earn several times, 1,000 times, 2,000 times your money, and there's 100% chance that everything blows up and you're not going to. I think recently an article was released on Startup Graveyard looking at some of the startups that have blown up in the last couple of years. So that part of high risk, high reward is very, very critical to understand. That's why the sort of investors that tend to put money into venture capital are quite selected. So if you're an individual, your money has to be very long. Your money has to be long, right? It's no, to don't have any deposit. If I put this one within 3 months, I will get this one. And the fact that is an illiquid asset class, that is not something you can enter today and tomorrow you are looking to sell. Typically, you stay for a horizon, and that's what you now also explained when you talked about the fund life cycle. And very, very important, right? And the sort of operation, starting from the fact that you have to raise capital from external guys as the VC fund, and then you now start investing. At that particular point in time, it's just negative. Cash is moving, so nothing is coming, right? And then when you start seeing exit, that's when you start seeing returns, right? And the way it was said in the book that at that moment you start rising from the ashes. I can imagine you start rising from the ashes. I think let me read that. Let me read that out somewhere. It says, this may be the case for about 3 to 5 years into the fund's life because VC invest in early stage companies and wait for 5 to 7 years before they start seeing returns. In fact, they may have to write off some of the bad investments early in the fund's life, which keeps the curve below the line at negative. But as the saying goes, weeping may endure for the night, but joy comes in the morning. For VCs, money represents exile, that the point when they start exiting some of their successful investments and begin to reap proceeds, the curve gradually rises from the ashes well above the negative line to the positive region, the point about the imaginary line of origin. So that's very, very essential to understand about the fund life cycle, and that impacts a lot of things, especially maybe even in modeling, creating the fund model, right? You tend to represent that. And what you also made mention about in terms of how it's structured, the GP and then the limited. Just let's talk a bit about the people. So if we want to do like an organizational structure, what a typical VC is going to look like. What are the different people that we have involved in VC?
Thanks. So again, as we previously said in the conversation, right, that two individuals or two different legal individuals come into play, LPGP, and decide that, oh, we want to do something together and all. Now the GP essentially being the VC firm, as you've said, represented by an individual called the general partner as well, um cannot do all of these things alone. So the VC then brings like other individuals on board. Number one is like the investment team is coached out, right? So in certain instances, the GP themselves are like ex investment bankers. They understand how to like do investment. In other instances, the GPs might actually be like more of an operator, maybe a previous startup founder and are not great at doing investments, but they are great at finding the best unicorn, finding like the best founders that can succeed. So the investment team is needed. Yeah, the investment team is needed. Like really helping in terms of like deal sourcing. How do you like get deals? Deal evaluation. How do we decide on whether to invest on this versus do we do due diligence on like both the founders, the customers, and other aspects of the business that are material. So you would see fund bringing like principal, CIO. So typically, right, remember that we also said earlier that you're looking for the odds of success. Odds of success comes with you also bringing in experienced individuals. So typically, funds will tend to have like more on the be more overweight on like the experience like principal and partner side. So these are people that have done maybe in investment banking before, venture capital, and that right skills to support on like the investment. So beyond like the investment partner or the associate and the analyst, associate and analyst essentially support the head of investment. In some cases, the CIO, we have like a chief investment officer because we're large. It's certain in most funds you won't find that, you just find an investment with the power, right? So after the investment thing, the next thing as well that we've established in this section today is that VC also like provide value creation activities, right? So that's where the portfolio support team comes in. So the portfolio support team, after the investment team has said, yes, we are investing, the VC has like deployed the money. The portfolio support team then they then, diagnose the startup and say, what exactly do you need to move from? You can proceed to C or another fit A to B, also or aligning with the founder's vision, right? Each VC has like certain areas they look out for. For us at Principal Collective, our portfolio support team is called platform. And then essentially we have growth team internally, we have partnership, we have business development. Even at Future Africa, we have something called like design, talent, storytelling. So essentially they start providing support to the startup and then helping to one, capitalize their growth. Second, also helping the founders save costs if they have those resources internally, right? So that way the founders can go so lean. The next thing, even outside portfolio support in is like fund operations, right? So fund operations are present in certain funds. In certain funds, they are not because like a particular VC can decide to outsource their fund up. Another VC can decide to just bring 1 or 2% in to do fund ops. So fund ops essentially, they are responsible for doing everything around like fund reporting. Because you collected money from the LP, you need to report your progress. The same way we are holding founders accountable to report to us, do the accounting work, do like all of the compliance work and the wiring, setting up vehicles and all. So the fund ops, essentially, you will see someone like maybe head of fund ops, or if the fund is like a bit bigger, also depending on like the market they invest in, they might have like fund ops associates or analysts to support on that end as well. Because I think after fund ops as well, we might see things like investment, yeah, like maybe investment relations, depending on the fund as well, or how big they are, and, and all of that. But beyond these individuals, I think a certain key aspect that is less talked about are actually like the investment committees themselves. The investment committees are the extension of like so like this thing is doing repeatedly right now. Because you did I happen? I would be
I understand. So because of time, right? I mean, to talk about what goes on, maybe one day we'll have a session on what goes on in the West. So bear with. Because of time, right? We just have about 4 minutes, but I think on a very critical part that people are very curious about. So maybe in just bullet points, right? People that are interested into in a career in venture capital, what are some of your top, what are your top strategies or your top three advice that you're going to give to them in terms of how to break in or how to get into VC? So we have just roughly 2 minutes for that.
be fast. One is like get transferable work experience, right?
Mm.
So like the VC is quite receptive to like fresh graduate, and I think it's even just opening up to like bringing 2 years work experience and the likes in the past. It's not that. So really think about all of these things we said yesterday. Just shows that from day one in VC you hit the ground running. So people with experience, previous experiences in like investment banking, private equity, venture capital, of course, like my profile already kind of show I'm here, and all right, just because they're able to provide that technical support around like financial modeling and the likes, or even maybe you work in startup as an operator, you might easily just transition into the portfolio support team, right? Because like you've done that, or the platform team and all. So that's one. So second thing is I would really say, if you do not work in these traditional pathways, find how you can volunteer, right? One could be like volunteering with maybe your friend in one fund, also, or volunteering with a startup, depending on what aspect of BC you want to pursue. You have to be clear on that. Second thing is also taking trainings. There are tons of courses on PFI. There are tons of fellowship, like being VC fellowship, EMA as well, all around there, helping people from non-traditional pathways break into VC and really understand what's going on. I think the main important thing is also building soft skills. This is relationship driven, from how you find the best deals, from how you manage interaction with founders, get feel on what is going on in the industry that won't make it to tech about tech crunch. So you really want to be great at networking, managing relationships so you can stay on top of that. The next point is really be on top of industry and news trend. Like tech about tech crunch to be your daily bread and butter. Fintech has been this, with this. What does it mean? Can you analyze data and use data for storytelling to see the trends that is going on and the sort of innovations that might happen in future? Maybe pitch that to the next VC, and that could get you a role on the fund. I think also like a core important aspect is also referral. With VC relationship build, and I would say that again, because from day one they expect you to hit the ground running. So people would typically hire someone based on referral network, either from founders or from other funds. I think I'm just one of the lucky few that applied publicly and broke into VC to Future Africa, and from then moving it's always easier, right?
What initially happened?
Follow them on social media, do all sorts of that, and just develop step. I believe that you'll be lucky.
Yeah, thank you so much. This has been very, very helpful, right? So if you're interested in getting into VC, Eunice has given you tips, have transferable work experience, be part of communities, understand the industry, look for referrals. And another thing is stalking fund managers on social media. See if
book, not just for those trying to break into venture capital, but also even analysts and associates that are already working in VC. I think personally, I found the book very interesting. Like the way the author broke down concepts into like simpler terms and relatable terms were really quite helpful, even though like these were things I already do in my work. I also think that if you are scrolling through the internet, like you find like different meaning to concepts, some that are not relatable, and the fact that this book just presents like a very coherent flow and break it down in simpler terms, I think really makes sense. And if there's someone out there, looking for ways to grasp an in-depth understanding of what VC is about, what are the various aspects of VC, and really understand the nitty-gritty of like where they fit in and where they matter in VC, I think this is the book to get. And I strongly recommend it. And I think even it's enough for you to go through this book end to end while preparing for a VC interview. And I'm confident that this will equip you with all of the knowledge and accelerate you to become even more successful in the process.